Welcome everybody to a special edition of the Not Your Average Investor Show. Today, we've realized in running our community now for 4+ years that most real estate investors, their first property that they invest in isn't necessarily the way that they would have done it if they were to start over again with some experience. Maybe it was a accidental landlord situation. Maybe you bought in a market because somebody told you it was great and it turns out it's not that great. Maybe you trusted somebody that isn't as trustable and you've been thinking about, well, I want to hold on to this property because I know that in rental properties, it's all about holding for a long time, but I don't want to hold on to this property. That's why we're talking about how to turn your headache home into a hero investment with 1031 exchanges. I am your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
And with us today, she is back on the show. She was a multiple time guest of the Not Your Average Investor show. She's the Senior VP Regional Manager of IPX 1031, that they specialize in this. This is what they do. They do these 1031 exchanges over and over, so much that she has lost count of the amount of 1031 exchanges that she has helped people with. Claudia Kiernan, welcome back to the show.
Hi, thank you for having me here again.
We've changed a lot, Claudia. I don't know if the first time that you were on the show, we started off with our usual tradition of the roll call. Are you familiar with the roll call?
No, I'm not.
Oh, okay.
How
Well,
does
you're
that
in for a
work?
treat because we got Lydia Filson, the mother of the godmother of the Not Your Average Investor Show community, checking in with us. We got Le Monsieur Reggie Foncé from the Inland Empire checking in. Bonjour, Reggie. We've got our ringmaster, Drew Barnhill, in the house. We got Jeff Pettyjohn from Missouri checking in. We got Ed Lowry from Jacksonville checking in. Mark Norman is back. Mark, always super valuable here in this community. We got Sergio Prieto. Go Gator. Sergio, good to have you back. And I see the community is just checking in. Good to have you all with us today. This is actually our last. Jose Solis, greetings from Florida. Good to have you, Jose. Deborah Silbar is saying hi, Claudia. That's a fan of yours.
Yes, hi. Yeah.
Yeah, there you go. There you go. So for those of you that are new here, we have a couple of like goofy antics because Greg and I do a weekly show called the Not Your Average Investor Show. It's at 12:30 Eastern every single Tuesday. Always have real estate education. Sometimes we have amazing guests like Claudia. Sometimes we're talking about the topics of the day and how they relate to real estate. Sometimes we're going deep on a subject, but all the time we have a vibrant community that shows up show over show. These are the folks that I'm calling out and have silly nicknames for, but that's the real value of coming to our shows, is that we have a community full of real estate investors just like you that have been through it, that have their own experiences, whether you're wondering about doing business with JWB or what you're doing is asking other questions, either you're getting unfiltered opinions from folks that are doing it, that have been doing it, and are experts in their own right in a lot of these areas. So, with all that being said, if you are new here and you know Claudia, right? Like Deborah obviously knows Claudia. Our community, you may have seen Claudia before. Claudia is an expert in 1031 exchanges, and Gregg Cohen is the co-founder of a company called JWB Real Estate Capital that's based in Jacksonville, Florida. They're a completely vertically integrated turnkey rental property investing company, and what that means is that they specialize in selling folks like me who don't want to manage my own real estate or find it or any of this. I want to be completely passive, selling us single family homes to own that are rented, that they either built or remodeled to a specific standard, and they take care of all the property management, and you also get a portfolio manager that helps you grow your wealth according to the plan that makes the most sense for you. About 120 people in that little operation of Gregg's that's been around for 18 years. They've been on the front page of the Wall Street Journal a couple of times. They've won Ernst Young. I don't even know how to say. I say Ernest and Young Entrepreneur of the Year award, and most importantly, they win Best Places to Work like every year because people are really happy working there. Do you see anything I want to add to that? 20 city blocks of downtown that you're developing, stuff like that. Oh, 6,000 doors under management. How can I compliment you more?
Yes.
Wow.
Yes, we are excited about all of that. But the most exciting thing is we just have this incredible relationship with our clients. I know I see many of the names in the chat. I see many of you here. Many of you show up every Tuesday for the Not Your Average Investor show. So these client relationships we have are amazing, and the network that we have is really amazing. And of course, Claudia is here, and she is a big part of our network and the go-to source for us for our own 1031 exchanges when we as a company do our own. So just really excited about the content today. I think it's really timely, and especially for as we're thinking about 2025 and how we're going to get ahead, a 1031 exchange is something that can absolutely help you do that.
Awesome. And Claudia, you've been doing work with JWB for a long time, right?
Oh my gosh. Greg and I were talking about that. I have been with IPX 17 years, been doing exchanges before that, but I approached JWB. Oh my gosh, I think it was like 17 years ago because I saw what they were doing and how they could help our clients. And I actually approached them and wanted to work with them. And it's been a great relationship. And their product has helped many of our exchangers solve one of the key issues with 1031. It's a short time period and they got to go out and find replacement property. And so JWB has a great solution for that.
Love it. And that's what we're kind of paint the picture of here. This idea of, hey, not just the way to replace a property, which is a 1031, but the easiest, most risk hedged, like best experience in order to do this for folks. So we're going to get into that. But speaking of reaching out and coming up with a topic of conversation, we didn't want to just call this the 1031 explainer. We wanted to talk specifically about a pain point, which is this idea that not all rental properties that you own are created equal. You may or may not have an underperforming property that you think is cursed, right? And you just want out of that thing. And maybe your partner is sitting across the dinner table telling you, why are we still messing around with this thing? But you know that you want to hold on to it. Or maybe you bought in a market where the dynamics have shifted. Maybe it's just not growing like it was before, things like that. Maybe you don't have the right partner managing it and you're just looking for better options. So GC, do you see this across the portfolio, right? Like I'm just talking about all the people that we bring on the show. Generally, when they talk about their portfolio, they're like, yeah, I got this portfolio. But that first one that I bought is usually the stinker.
That's exactly right. How often do we hear that on the show? And for many people, it takes so much courage to get to get to that place where you buy your first rental property. It's always a shame when folks buy that first one and they're not ecstatic about it. And many times it's because they don't have a great management team. It's not a vertically integrated management team. And there's all these warning signs. But what this show is about is helping people realize if you are in that situation, if you do have properties in an unnamed place in the country and either your personal experience is not great with those rental properties, or you realize now that that is not the ideal market to grow your rental property portfolio, you're not stuck, right? There are so many of us that are sitting on hundreds of thousands of dollars of equity in these properties. As a country, we have trillions of dollars of equity that we are sitting on in our real estate, and that is an untapped resource. And so if you happen to be in one of these markets, not only can you divest out of those markets and invest in the right team and the right market for you, but you can do it in a tax advantaged way. And so today, and the reason we asked Claudia to be here is to help us bring this to life. And we're going to include some real numbers as well, because I want you to see the power of making a decision like this using a 1031 exchange. And we're going to make it real simple too. I'm going to speak from a real estate investor's perspective of return on investment, additional properties in your portfolio, and really try to make this complex topic very simple and easy to understand.
Claudia, in marketing, we like to say that people run away from pain faster than they move towards pleasure. And when I think about how you get business, I assume this is a little bit of both, right? Some people maybe are looking at a market like Jacksonville that's just absolutely booming and thinking, all right, I'll move my chips over there. But some people are doing what we're saying, right? Like, oh my God, this property over here just isn't working for me. I want to change it. Do you have a sense of, like, when you talk to a client, what percentage is like seeing a better opportunity somewhere else versus saying, I realize I just got to get out of this other one and keep doing what I'm doing just somewhere else?
Yeah, it's kind of mixed, but we have a lot of our clients that are getting older. Maybe they don't want to manage those properties anymore, and they want to find something that's kind of less headaches, less dealing with all the ins and outs of managing that property. And then the other, yeah, it's huge, is where we have a lot of our clients moving from areas where the price point might be too high, or they're not getting a good return on investment on that property. So they want to move it. And as Greg just mentioned, so many times there are our clients, before they really learned about a 1031 or learned about what they can exchange into, they definitely think they're stuck with their property because they think, okay, I've owned this property for a long time. It's appreciated greatly, or I've depreciated it because I've owned it for quite a while. But I'd love to get into another property, but I don't want to pay all that tax. So the 1031 exchange and then having that perfect replacement property works well together.
Love that. All right. So we're going to get into this. We have a whole presentation with you. It's got a couple of case studies. It's got some hard numbers and stuff that you're going to want to see, right? So, what we find in doing this thing once a week and having a community is that nobody takes, people all think that they want to take a screenshot of a slide, but you never actually go back to look at your screenshots, right? So much easier is to text us 904-293-0341, and we will send you this presentation, right? This is also the perfect first step to take if you want to hop on a call with an expert at JWB to just kind of get things going, or you have a question about, like becoming a client, or you have a question about a deal that you're looking at, stuff like that. JWB has a team built to answer those questions. So just do yourself a favor, text 904-293-0341 to receive this presentation now, and that way you can just follow along happily as we do it. I just put it in the chat for anybody that wants to copy paste it. And then this is the last super boring slide that we're going to put up here. It's the due diligence. GC, you are great at this. Go for it.
Yeah, absolutely. You know what? This is a presentation is here to help. We're going to have real numbers. Just know that all of these numbers are estimates only. Nothing is guaranteed. You probably expect that. And if you're thinking about making a really important decision like investing in real estate or doing a 1031 exchange, let this be the beginning of your journey. This is not the end of your journey. We are not financial advisors. We are not giving financial advice, but we are here to help, and we're so glad that you're here to learn.
Okay, so speaking of learning, Claudia, what is a 1031 exchange for those of asking for a friend, right? I obviously know, but my friend wants to know. My friend wants to know.
So the 1031, is actually referring to a code section in the Internal Revenue Code. And you think, yikes, who wants to talk about that, right? But it actually is a fascinating section. It is really considered one of the biggest wealth building tools in the code because it allows someone to sell property either held for investment, like you could have a residential condo that you're renting out, single family home, vacant land. It could be commercial property. Maybe you're retiring from your business and now you're going to sell that. And you can do a 1031 exchange by acquiring other like-kind property held for investment or business use. So any real estate really qualifies as long as it's investment, and defer all the capital gains tax that would ordinarily be due. So, instead of that money going to the IRS, you get to use that and to reinvest in more real estate. By the way, it is also considered 1031 one of the biggest economic stimuluses we have in this country. And the reason for that is because when you reinvest in more real estate, you are investing in a local community, you're improving property, you're, paying property taxes, and you're creating jobs. So it's been part of the code since 1921, right? But it always kind of startles me that so many people either don't know about a 1031 exchange that's got to be set up prior to the closing of the sale. You got to have a qualified intermediary prior, right? So, or they just have something wrong about the 1031 exchange, the rules, right? So we're going to kind of discuss all that today.
Yes, we will. GC, you have a funny way of simplifying things for real estate investors.
Well, so as a real estate investor here, what are real estate investors always looking for? They're looking for capital, right? They're looking for capital. And so when I hear about a 1031 exchange as a real estate investor, you know what that is? That's just unlocking capital right there. What you're able to do is to not pay the taxes that you otherwise would have to pay on the sale of a property, keep that capital, and you're able to reinvest that. And that's really powerful, along with the idea of using that to invest in really wonderful investments, right? So it's the ability to unlock capital is how I think about this. And then when you unlock that capital, you put it to good use. You put it into a JWB turnkey property or another investment. And then that capital now is earning a great return on investment, and it compounds over time. So I totally agree that this is one of the best wealth driving strategies. And Claudia, I'm really glad that you picked up on not just what it's doing for us as individual investors, But I think as investors, sometimes we don't realize the great things that we're doing by our activities in our neighborhoods, in our communities, and across our country. And a 1031 exchange is a great way to take maybe one asset that might be happening in another high price market and turn that into 3 or 5 assets in a market like Jacksonville. And you are improving neighborhoods and you are improving your country. So I'm so glad you brought that up. I think that's really wonderful.
Yeah.
I love it. It's reminds you, two things that I like to say is that real estate really is the spine of the American dream, right? Like this is just another use case of that. But the way that I explain 1031 exchange is essentially if I bought a house for $100,000 in LA County in 2006 and now it's worth $600,000 and I'm pissed off that they're putting rent controls and whatever and I want to get out of there, I can sell that house for $600,000. Once I sell that house, I have the $100,000 that the house was worth, and then I have the $500,000 in appreciation. A 1031 exchange allows me to use that $500,000 worth of appreciation and put it into another property or another set of properties, likely, right? If that's what you're doing, without paying taxes on it first. So you let it ride. You're letting the profits ride for you. And that way, instead of, being able to buy instead of having to pay whatever, let's call it 25% tax on that $500,000. So now I only have $375,000 to spend. I'm doing math in public. I'm really nervous right now. But instead of that, I have the full $600,000 to spend. Again, I don't know even what I'm saying, $500,000 to spend. And that means maybe I can buy an extra property or two because, like with a 25% down payment in a low price market like Jacksonville, that's $250,000. Now we're cooking with grease and you're really just like parlaying the real estate profit. And that is kind of the magic of it. But Gregg, there isn't just that. There isn't just the idea of like keeping my money, putting it to work. You believe that there's a way to actually increase profits with 1031 exchanges, right?
Well, yeah, absolutely. You may be in a situation where you are cash flow negative. Let's say that you have debt on a property that you bought in California is an easy target because home prices are so high there and rents don't keep up. So the chances of you having cash flow positive situations or a good return on investment of that cash flow is unlikely in California today versus what it would be in Jacksonville today. And so you're able to take a property that is not performing either on a cash flow basis or on all 5 profit centers. It might not be performing for you as an investor experience because you don't have great management in place, and you're able to repurpose that capital. And so you're taking it from an underperforming asset, one that might be cash flow negative or maybe has more risk involved out there in a different market, and you're able to repurpose it into a market where you want to be, where you have great management in place, and that return on investment is much better from all 5 profit centers. And that's how it's not just getting the capital, it's making the capital work harder for you by allowing you to put it in the right market.
How'd that
And
land for
also
you,
to
Claudia?
add, sorry to add to
Yeah.
that,
Yeah.
in that example that you guys are talking about selling in California, where you have state taxes, right? And very high state taxes. And if you sell in California and do a 1031 exchange, you're also avoiding as 13.3% tax for California. And then now when you have a property in Jacksonville, now you don't have state tax, right? So that's another added bonus.
So there's the deferment of the tax, but then if you're moving from like a state tax to a non-state tax place, you kind of like skip that out. I didn't even
Right.
thought
Well,
about
you
that.
get a better return on your investment, right?
Yeah. You add that
That
to the
doesn't
top.
even
To
show
the
up.
top.
That doesn't show up anywhere in the property evaluations that we present to clients, the state income tax component.
I think
So
we should do
just
some
great.
content about that. I think we should do some content about that. GC. All right, cool. So that being said, we're understanding kind of like what it is. We're understanding the benefits of this thing. There's a lot of benefits to it. Before we get to these case studies that you put together that shows real returns and real dollars so that everybody grasps this thing. Claudia, can you just talk us a little bit through, this isn't just like, all right, we got a property over here, I'm going to buy a property over there, easy peasy 1031, right? Like there are some technicalities and things you have to know of how this thing works, right?
Yeah, absolutely. So what I had mentioned earlier, if you have to have the exchange and exchange documents in place on or before the closing of your sale property. And then what has to happen is you want to always, to be fully deferred, you can also do a partial exchange, but we'll get to that. But to be fully deferred, which would be the goal, we don't want to pay any tax, right? We want to buy a property or multiple properties that are equal or greater value to what we sold for minus our closing costs, right? That's key. So not only is our gain needs to be rolled over, but so does our tax basis or what we have into the property. So it's always equal or greater off to this of the sale price. If, we have some clients that have a very large gain and they'll say to me, you know what, Claudia, I do want to do a 1031 exchange, but I wouldn't mind keeping 50,000, right? To maybe go buy a new car, take that vacation that they've been dreaming about. That's completely fine. So we can do a partial exchange by either buying for a lesser value or putting some money in our pocket. But the other key basic rules is that you got to move pretty quickly in a 1031 exchange, right? So once the closing happens, that's going to start the clock ticking. And so we have 45 calendar days to identify what we're going to purchase. That's not really very long, right? Calendar days. So if the 45-day deadline hits on a Sunday, we don't get to Monday, right? It's that Sunday. And then we have 180 days to close. Both these timelines run concurrently. So once we get to day 45, we only have 135 days left. The number one killer for a 1031, if there is going to be one, majority of our exchanges are successful, but if there is an issue, it always has something to do with this identification, right? Because once we identify those properties and we get beyond the 45th day, we cannot change what we identified unless we have disaster extensions, which we do have some right now in Florida, but we can't change what we identified. We're stuck with those properties. So you really got to move pretty quickly in a 1031 exchange.
And therein is the nuance of the value of this call in identifying the best way to do this, right? Like in identifying a way, right? Like if you aren't already savvy about 1031 exchanges, you don't know that this risk exists. But some people that are savvy about 1031 exchanges are savvy about it because someone like Jag in our community who had originally working with a company that was going to provide her a rental property, but it wasn't vertically integrated. So the person had a property that they were going to flip to them, and then the deal didn't work. So then they had to identify another property, and then they didn't actually meet that window, and it was a very expensive lesson. But the way that Gregg and his team at JWB do it, very, very different than that. You want to explain why this is the easy, low risk way of doing this thing so that this doesn't happen to you?
Yes, it is all of these, we'll call it hidden benefits of working with a vertically integrated provider that we try to bring to life. And while you can't quantify it and put it on a spreadsheet and say that this is worth this, you know how much it's worth when it doesn't go well. And in a 1031 exchange, it is so important to hit those timelines like Claudia was sharing. So if you're working with, call it a non-vertically integrated company, you're taking a lot of risks. You're going to see how much risk you're taking when we looked at some of the numbers and how profitable a 1031 exchange can be. But just to that point, Jag's story is a very good story, and it's one, unfortunately, we hear a lot because there's the JWB way, the vertically integrated way, where JWB owns all of the assets ahead of time. JWB builds the home. JWB then puts a resident in place for the home and then sells you that property. There is complete control of the asset between you and JWB. There are no third parties. There are no things that are going to get in the way. And the fact that JWB always has inventory available to source the needs of a 1031 client is very, very unique. Let's juxtapose this to the normal way of buying real estate. You listen to a podcast and you think that buying a rental property is a great idea. You haven't really looked into the market, or you don't really have a real estate professional to help you on. So you just find somebody. Well, that real estate professional is going to take you on a number of circles to go out and put offers in on a property. Well, when you only have 45 days to identify, sometimes you put an offer in and you don't hear back for 45 days. And so, the normal way of buying rental properties just typically does not work well for 1031 exchanges, because the idea of finding those properties in 45 days from the time that you sold your previous property is just very unlikely and unrealistic to do. So that's the value of a vertically integrated company like a JWB. If you give us a call, if this webinar today sparks an interest in you and you say, hey, you know what, I'd like to think about doing that. The timeline from that first call to identifying properties might be a week, might be 2 weeks. right? It's not 45 days, and you get to make the decision right then and there on the assets that you want to look at. So a huge, huge value for working with a vertically integrated provider, and one that makes all the difference. And you know it if it doesn't work out. That's when you know the value of a vertically integrated provider.
On my bingo card, I have vertically integrated 7 times and JWB 14 times there that you mentioned in that explanation, Greg. Good call. Good job. Good job on that one. The way that I like to phrase it is the reason why JWB, there's another one, has been on the front page of the Wall Street Journal a couple of times is because they have figured out a way to like widgetize an assembly line, the bringing to market of these rental properties in a way unlike any other company in the United States, right? Like at least when they started, right? Some people are trying to catch up, but they really have this very, very controlled way of doing it where they own these properties ahead of time because guess what? They can own it for some time because it's a cash flowing asset. It's an incredible business where your inventory makes money for you until you sell it. But that's the beauty of it, right? Like you guys have 6,000 doors under management. Your group, like you and your partners yourselves, own about 400 of them personally. So even when you're bringing them in and out of market and bringing them to market, you have this like surplus supply that nobody else has the value of it. And therefore, this risk is mitigated of it not being ready in your 45 days and in that timeline. So that being said, I put the number in the chat again, 904-293-0341 if you want to get that process started, or you're going to want these case studies that we're about to get into right now. As soon as we answer 2 quick questions, y'all ready for 2 quick questions?
Let's
go. Let's go. Mark Norman says, hi, Claudia. It was great working with you and your company this fall. The 1031 exchange went great. Thank you. Questions. Does the IRS have some kind of record that indicates a particular property was obtained via 1031 exchange, so they know that the cost basis is connected to the previous relinquished property? Also, let's just start there. Does the IRS have a status notification like that?
Right. So it's great to see him that you're on the call. It was a pleasure working with you. But yeah, what's going to happen is your CPA or tax advisor, accountant, whoever's filing your tax return in the year of the sale is going to include a form for the 1031 exchange. It's called the 8824 form, 8824 form. And it's just a worksheet. It's going to show what you sold, right? And then, when did you identify your properties? And then what you purchase. And then what happens is your tax basis in the sale property moves over into your new properties. And typically tax advisors are going to proportionately allocate the basis into each of your replacement properties. So yes, there is a way that they're tracking the 1031 exchange with your tax return.
Great, concise answer. One more question from Mark there. Also, what is the best way to calculate and keep track of the new cost basis for each exchanged property?
So it will be on your return, like I was saying. So if you're filing your individual tax return, the basis will be moved over and then you'll see it. I think it's like your Schedule E, right? So you'll see your basis for each of your properties. It kind of is like a little puppy dog. It's going to follow you along. It's just that in your exchange, I believe you diversified, right? Which is a great strategy. You buy one and you sell one and you buy multiple properties, right? Power of leveraging. So your basis will be allocated to each one. So that's just part of when they're filing your tax return for 2024, that's how they're going to track it and you'll be able to see it. So if you gain another, let's say $100,000 on your investment in Jacksonville, then when you sell, you'll just have that gain. It's always going to be sales price, minus your adjusted basis, which is going to, as I said, follow along. If you went up in value in your replacement property, your basis ticks up as well.
Nice. Like it. Form 8824, correct, right?
Yes.
Okay. Greg, does the portfolio managers, like when you buy a property with JWB, you have a portfolio manager that kind of helps you along your journey and doing taxes and all these, not doing your taxes, but like helping you get organized for taxes. Does the portfolio manager keep track of that type of stuff?
The portfolio manager is going to help equip you to give the information to your CPA so that you can do your own taxes or your CPA can do your own taxes. My team's not going to know Form 8824.
Okay, cool.
But they're always going to be one phone call away.
I got it. Part of the vertical integration.
And what I didn't add to mine too is we have an accounting statement which shows for all of our exchangers, what we received in funds, what we wired out, when there was the 45-day deadline, and we keep obviously all their documents handy for them. So
Cool.
it makes it
Cool.
pretty easy.
Awesome. Awesome. Thanks, Claudia. All right, we're going to get into these case studies as soon as we answer Le Monsieur Reggie Fonse's question. If I sell my multifamily rental in Maine and plan on buying 2 properties or more, do they all have to close within that timeline?
Yeah, they would all have to. Well, so if you sell in Maine and you want to purchase multiple properties, you just got to identify the properties within the 45 from the closing of the property in Maine. And then they don't have to close. The replacement property they don't both have to close at the same time, but they have to close within the 180 days.
Mm-hmm. Is there anything to the idea of him selling a multifamily rental? Like if it's got like I own a duplex. If I wanted to sell it, but I would have to sell both sides at the same time in order to be able to do
Oh,
this.
sorry. No, not necessarily. If they can be sold and owned separately, we could set up separate exchanges for each side. Like if there's going to be between what we call the relinquished property, the first duplex or unit is going to happen way before the second. We definitely want to do 2 separate exchanges, especially if we have 2 separate contracts and 2 separate closings. So it was just something we can look at that time. One of the tricky things is, though, if you're selling multiple relinquished properties and you want to go down to one, it's just that first sale property will start the clock ticking if it's all going to be in the same exchange. So sometimes it's best to maybe separate them out and do separate exchanges. And then you have a new timeline for each one.
Got it. Reggie says merci. All right. GC, you ready to share this case study?
Absolutely.
Let's go, buddy.
Let's go. All right. So I thought it would be good for us just to put ourselves in the shoes of a recent client that used this exact strategy. And let's understand the problems that this client came to JWB to solve and how Claudia's team helped solve those problems. So we're going to take a look and just kind of get inside their head as they were going through this process. So here's kind of the lay of the land. This client owned a property in Arizona, wasn't performing, but had lots of equity. And so they were a part of this community, and they said, well, you know what? Let me see if I can find something that's better. It's going to perform better from a return on investment perspective, but my experience is going to be better because I'm going to work with a vertically integrated provider. Of course, there wasn't a vertically integrated provider for a management company available for that property while in Arizona. And again, understanding the right market for reducing risk and increasing profitability. This client was convinced that was Jacksonville and working with JWB. Also a big opportunity to diversify. And Claudia mentioned this a few minutes ago. It's just really nice when you have multiple properties driving this return on investment rather than just one. If you're a JWB client, you've probably heard the value of getting to multiple properties. Pablo, we talked a lot about the value of getting to multiple properties and really a target of getting to 3 properties sometime near in your early journey with rental property investing. Can you share with everybody why that mattered to you?
Yeah, it mattered to me. Just it kind of smooths out the experience. I might be having a vacancy or an issue at one of my properties. And if I own one property, then that's all that I got going on. I've got an issue with my real estate portfolio. Whereas if I own 3, then while that one property may or may not be in a moment of, moments that happen in real estate where things have some like temporary pain, the other 2 are still performing well. The cash flow from the other 2 are making up for the cash hit on the third property, and so on and so forth. The chance of like all of them being down at once is very, very little, but the chance of like one, being down every like couple of years, having like a 1 or 2, months of a turn or anything like that, that's bound to happen. So you want to have that kind of like smoothed out experience with it.
Well said. Well said. I mean, we're trying to do 2 things. We're trying to smooth out the cash flows for you, right? From a return on investment perspective and just cash in and out, having multiple assets smooths that out for you. Because the reality, and take it from somebody who owns hundreds of rental properties, you are always going to have some issues as you get to own 3 properties, 5 properties, 10 properties. You're always going to have something. But it's okay if you have multiple streams of income coming in those multiple assets. And the most important thing, guys, the way you win in rental properties is you stay in the game. You love this asset enough to stay in the game for 10 years or more, 20 years. And that's when this asset just kicks butt versus alternatives. So we're trying to mitigate for challenges in the investor experience. And if you only have one asset, it's feast or famine. So we do want you to get to 3. And that was a lot of the conversation with this client as well. And then, he was very knowledgeable on 1031 exchanges and the value of deferring the taxes, the concept that we're speaking here today. So that was really exciting. And there's also an opportunity to not just defer taxes on this decision and these purchases that we'll show here in just a second. We're excited about the opportunity to defer taxes indefinitely. And one thing we wanted to bring up is that there's no limit on the amount of 1031 exchanges you can do. This can be the first of many 1031 exchanges, which is really deferring your taxes indefinitely. And ultimately, if you happen to pass and you own rental properties that you've done 1031 exchanges on, guess what happens for your heirs? Well, what's going to happen is called the step up in basis. And that means that you have deferred the taxes indefinitely because the basis now becomes their purchase price and they just don't have to pay the taxes on all of those gains over the year. So excited about all of those opportunities. And when he came to JWB, we look at this and we say, okay, client's got a problem. What solutions can we offer? And we build out this plan. And man, we were super excited to start this conversation with this client.
Speaking of excited, this client that we're talking about may or may not be in the audience today. So if you recognize yourself here and you want to identify yourself and let people know that it's you and beat your chest about what a great idea you had, feel free, but we're not gonna identify you. We also have some questions coming up. Once we're done with the case study, we're gonna dive into the questions. But for now, Claudia, as Gregg is explaining this, Luis Olivares is asking for your contact info. So maybe you can type in your contact info in the chat as Gregg is explaining all this.
Absolutely.
All right, let's go.
Yep.
All right, GC, you ready to keep going?
Absolutely. So first things first, what did this client do first? Well, the first thing they did is they talked to our team. They came to JWB and they said, I got this idea. I think I can do something. Can you help me? And that's what I want to encourage all of you to do. That's that text line, right? So if this is an idea, even if you don't have a formed plan yet of how a 1031 can help you, this client reached out to us and we built the plan with that client. So again, that phone number to do that, 904-293-0341. This is step 1. That's what it was for that client. When we build out this investment plan, we're taking things into account like, what are your goals? What are your income requirements today? What are your income requirements in 5 years, 10 years, 20 years? What are the returns on investment? What do they need to be in order to accomplish those goals? And as you'll see in the case study here, this was a very specific plan for this client, and you'll see kind of how we worked through that. When we
GC, real quick, as you're catching your breath there, Sue Pin is asking for you to talk a little closer to the mic, if you can.
Ooh,
or maybe
I can do that.
Or maybe, oh, look at that. They sound way better. It's because
Much
I'm not
better?
there to fix it for you. Yeah, it's because I'm not there to fix it for you. All right, keep going, GC.
Absolutely. Thank you so much for that recommendation there. So we're talking about the value of the plan. Once we understood what the client's goals are, what the resources are, how we can use the tools to be able to put a great plan and a great strategy together, we said, all right, we know what the strategy here is. It's a 1031 exchange. This is going to help this client. And the next thing we do is we call our buddy Claudia up and we call our friends over at IPX up. And we refer this client to work with Claudia's team because you absolutely need a team of experts to put something like this together. And there is no way to pull this off, in my opinion, without working with the best of the best, especially when it comes to a 1031. So Claudia's team was super helpful. While the conversations with JWB are going on, we're advising this client on how to do this alongside Claudia's team. And the first thing the client has to do is to sell that original property out in Arizona, but there has to be a plan. You can't just sell the property and then start this process. You need to talk to JWB before. You need to talk to Claudia's team before, because like Claudia mentioned, the clock starts ticking right as that property is sold. So this client had a plan, sold the property in Arizona for $483,000. And then, of course, the plan was put together with the idea of reinvesting the maximum number of profits, not being hindered by taxes that he otherwise would have had to pay, and reinvesting those gains into 3 JWB turnkey properties in Jacksonville, Florida. And we'll show the properties on the next slide so you can see these assets that this client added. But Claudia, what did I miss there in that just kind of general overview of how the process would work for this client or clients in general?
Absolutely. So we initially will have a conversation with our client, kind of go over how the 1031 exchange, the process, And then the key thing, not only that the documents have to be in place before the closing, but one of the roles of a qualified intermediary is to protect our clients from constructive or actual receipt, right? Actual receipt is and we get these calls all the time, unfortunately, where someone will call up and say, hey, I got your number from so-and-so, love to do an exchange. And I'll say, well, when's the closing? And they'll say, oh, the closing was last week. We can't help them, right? Because not only are the docs not in place, but they receive the funds. Or even if they just sit for a week with the settlement agent, well, the settlement agent is their agent, right? So it's constructive receipt. So what happens is your closing is going to happen like any other closing. We make the process very easy by just sending you the documents, typically through DocuSign, if that's what you prefer. And then we send our wiring instructions encrypted to the settlement agent, or it could be out west to be escrow officer. And then they're going to wire the funds to us. Once we receive the funds, we let you know we received them. All funds go into segregated, separate accounts. And then we're going to give you the 45-day deadline and the 180-day deadline. But yeah, Greg, you covered perfectly.
Yeah, and I'll just add on to there. Guys, sometimes there are deadlines that we can creatively get around in life. This 1031 exchange deadline is not one of those, right? Like me personally, we have tried to set up 1031 exchange and the properties just didn't close in time. Of course, this is not working with IPX or whatnot, but in my past days, right, we tried to do this and I felt the pain of thinking that it was set up correctly, but it didn't happen in time. And there was no getting around it. And I'm a pretty creative guy. So I'm just reinforcing how important these deadlines are and how important it is to work with the best of the best here. And with that, I'll keep going. So let's keep going on this case study here. So these just happen to be the three assets that the client purchased here. So really wonderful assets, very typical for JWB inventory here. But let's break down the numbers of how did Claudia's team, our team, and this client work together to set this up to accomplish their goals. And we'll go ahead and switch to the next slide there, Pablo, unless you got something that you want to.
Yeah, I was just complimenting Mark for being here because he's owning up to it being his 1031 exchange.
I wasn't going to be the one to say it.
Yeah, he's in the chat. So just a very cool resource. If anybody has questions, the person that we're talking about is here. I'm sure he'll answer some questions in the chat if you have any. Continue, GC.
Absolutely. So we were all kind of sitting on our hands over here. It is so wonderful to have you, Mark, and it's great to share your success here. So this is Mark's first property that he reinvested into using the 1031 exchange. And let's look at why we set it up this way. So, purchase price here of 227. Claudia, now there's three properties here, but why is purchase price important to take note of on this property?
Yeah, absolutely. So going back to what I said initially about the basics of a 1031 and being fully deferred, is that you have to buy for equal or greater value to your sale price minus closing costs. Excuse me. So the purchase price is super important, plus making sure that all of the net proceeds in this example from Arizona, right? The Arizona sale is reinvested in the replacement property. So we got to meet those two key things: replacement property value or purchase price, and then making sure that all of the proceeds from the sale property is being utilized in one or multiple properties.
Absolutely. So just a key there, right? Sold it for 483. You can get to that higher purchase price over multiple properties. It doesn't always have to be just one property is higher than that previous sales price. And that's what you'll see here with Mark's portfolio. Something else to notice here, exchange proceeds of 125,000. And we'll do a deeper dive on this one, Pablo, but exchange proceeds of 125,000, new loan amount of 112,000. Claudia, can you talk a little bit about why that's important? What do exchange proceeds means? And we would normally talk like down payment, right? But we call them exchange proceeds here. Can you talk a little bit about what is important about that, the way that we set that up right there?
Yeah, absolutely. And it goes to that final return that's going to be filed and making sure that we hit all the key points in a 1031 exchange, not only the deadlines that we've been talking about, but that what we call exchange proceeds is what we receive net of closing costs on the sale property, what started all this, right? That Arizona property. So it's the net proceeds we receive from the settlement agent in Arizona that is going to be utilized to purchase the replacement property, right? And the one thing I don't remember is with Mark's, was there debt on the sale property on that when we
There was
first?
not.
There was not, right? So as long as we are going to use all those proceeds, so one of the strategies that is so used or most often used is this diversification strategy, because as we've been saying, it's a way to grow your real estate portfolio, get a better return on investment. So you're using not only the net proceeds from the Arizona property, but you're leveraging as well so that you can buy even more real estate, right? So we're going to use the net proceeds to put down as a down payment on, in this scenario, 3 properties. So we have that exchange proceeds going in there, a down payment, same thing. And then we could borrow the rest.
Absolutely. So some common questions are, can you get loans on the properties that you are exchanging into if you didn't have one on the previous one? Yes, absolutely. Here's a great example of it. And if I think about how Claudia's team and JWB works really well together, of course, JWB is here to build the plan with you, helping to understand how we're going to accomplish whatever that goal is. And we're going to help to understand, we're going to bring the assets to the table. Claudia's team is going to make sure that the maximum amount of tax savings is accomplished for you through this 1031 exchange, along with a lot of other services. But that's where knowing the rules that the purchase prices need to be this and the exchange proceeds need to be this, so that leaves this amount for the new loan to come in. That's why you need a complete team here to make sure that you maximize this, like we were able to do for Mark. And now Mark has this one asset here that's rented for over $1,300 a month. It's on a 2-year lease. It's producing better cash on cash returns, better cash flow, and better rate of return because he's in a growing market here in Jacksonville. And so we can kind of go through the same scenario here on property too. We just won't go as in depth, but you can see the same logic here is applied. Of course, all 3 properties are put together in the plan at one time, but this is how it shakes out. He was able to purchase a second property. The purchase price on that property is $278,000. And you can see that about half was the exchange proceeds, that is in essence the down payment. And then about half of that is the new loan amount, which is $144,000. So we're accomplishing the bigger goal of diversification and better returns and better cash flow. We're making sure that we're maximizing the exchange proceeds so that we get the max tax savings on each one of these. And then the difference is the loan amount. That's how we did it. And then here's the third property. Same thing, right? Maximizing the tax savings by using the exchange proceeds and filling in with the loan amount. And I should point out here that it was really important to maximize cash flow. If you notice, the exchange proceeds, or the down payment, we'll call it in real estate investor terms, is significantly higher than what was needed, right? Mark could have put down a lot less, but that was not right for Mark's goals. By putting down more, using more of the exchange proceeds, it provides a lower loan amount, which means a lower monthly mortgage payment, which means more cash flow. And so this is the value of the plan. Once we understood that this was important for Mark, we put this plan together and said, it's not okay just to maximize the debt on this. We could have done that, but it was important to maximize the cash flow as well. And of course, we can put either of those types of plans together. That's the value of sitting down with our team, and we'll come up with a strategy for you.
What I'm reading there, GC, is he possibly could have bought more with that transaction, right? Like, it's so, as long as you are following the rules, you are buying, you're spending the money on equal or greater value, right? And like, you're hitting these windows, there is a couple of different options here, right? Like, it's not just okay, so if I'm selling this like really expensive thing in LA or San Francisco or Atlanta or New York or Miami, and I'm moving it to Jacksonville, it's not like, okay, so how many houses can I buy now? It's really just like, how can I make this thing work better for me? It's not even just like, how can I get more returns or anything like that? It's literally just like, how can I make this better for me? Which for most people, it's going to be like, how can I increase my returns? But there's also different levers to pull as far as increasing your cash flow, or, increasing your leverage, maximizing portfolio value, things of that sort. And that's why it's so valuable to text 904-293-0341 and hop on the call with JWB, because JWB is going to kind of like help you think of those decisions and build a customized plan, while Claudia and her team are just like worrying about the mechanics of it all and taking that off your shoulder, right?
Well said.
Go
So
ahead.
I want to kind of just bring the point home here. And when you ask me, hey, what do I think about when I think 1031 exchange? I think capital. So I wanted to show everybody in real numbers what this meant for Mark's portfolio. And really, by using a 1031 exchange, what you'll see is Mark was able to buy 3 properties. If Mark did not use a 1031 exchange and did the exact same thing, he would have paid all that money to Uncle Sam. Instead of paying all that money to Uncle Sam, Mark was able to use that to now acquire another asset that is going to perform for him for years and years and years. So simply by attending a show like this, becoming educated, working with the right team, building a plan, Mark was able to walk in with an additional rental property, sort of gifted to him by the founders of the 1031 exchange code and the IRS code from back in the day. And here's the number. So if we go back to a different decision, Mark did not decide to use a 1031 exchange, the column on the left is how it would have gone. The sale of his prior property was $483,000. He had about $30,000 of closing cost on that sale. So his taxable gains would have been about $450,000. Now, assuming a 25% tax rate, which it's an assumption, obviously it changes a little bit depending on where you live and all this good stuff. Assuming 25%, that means that there's $112,500 that Mark would have paid yesterday or whenever that closed. He would have had to pay that in that tax year, which would have only left him with $337,500 to reinvest. And then again, because we built the plan with Mark and max cash flow was important and 3 was the right number of properties for him, if he wanted to put down that 60% and have that max cash flow, he would have only been able to acquire 2 JWB properties. Now, because he used the 1031 exchange, sales price of the original property still $483, still had the closing costs, still had taxable gains of $450,000, but he used the 1031 exchange. So he no longer has to pay that $112,500 to Uncle Sam this tax year. He's able to use that to go and buy another asset. So he has the full $450 to reinvest, which allows him, in conjunction with his goals, to wind up with an extra asset here, to wind up with 3 JWB rental properties. And this is the same type of planning and execution that can be done for you if you find yourself in a similar position to Mark, where you have an asset that it's not just performing either on a returns basis, cash flow basis, or just an experience basis. You can be just like Mark, and you can wind up with extra assets by using a 1031 exchange.
One thing I was just going to add to this, which is powerful, right? Because you're, again, able to use that money that would, once you send the money to the IRS, it's never earning another penny for you. So you get to go out and use it and put it to work for you. When this was put together, when we look at taxable gains, right, it's the difference technically, but we're just putting this together as an illustration. We really don't know what Mark's actual taxable gain would have been. But when you look at the formula, because I get this question a lot, what is my taxable gain? Well, it's going to be sales price minus your closing costs. So we have the 33,000 there, minus your adjusted basis, which is, what you bought the property for, plus capital improvements, minus depreciation. And then when we did the taxes to be paid, we're just doing an assumption of 25%. It's just kind of a blended rate because a lot of factors go into it, right? We have long-term capital gains tax, right, on the appreciation, which is either 15 or 20%, depending on your taxable income. Then there's the 3.8% if you have a certain amount of investment income over 200,000 or 250. Then there's state taxes, right? And then there's depreciation recapture. So it's specific to each of us what, that number is going to be. But we have to put something in there to illustrate the power of a 1031.
There you go. And Mark is saying, yeah, I could have probably bought 5 properties, but I also didn't want to stretch myself too thin. I just felt more perspective from a debt perspective, more comfortable from a debt perspective of where I am in my life right now. And FYI, I live in California, so savings in state taxes was important too, right?
Yes.
So that is a whole nother bucket. Claudia, what I'm really curious about is whether you and your team do the math of like how many extra houses people have bought because of that spread of the 1031 exchange. That would be a really interesting, I mean, not an
I'll
easy
have to
metric to
think
track,
about
but
that.
man, what a
Yeah,
scoreboard,
right. Oh, it would be
right?
amazing. Yeah,
Yeah,
yeah.
I love the illustration, but it makes it so real when Greg talks about like one full house added to your portfolio thanks to this lever makes it so powerful. So if I'm looking at this, GC, the immediate thing I'm thinking is, all right, cool, got it. Super powerful, super easy. Want to do this because I have a headache property somewhere. JWB seems like they know what's going on. So let's talk about what the current inventory, what that would actually look like right now, Reggie.
Yes, absolutely. So here's just our current assets that are available. I won't spend too much time here because I think most of the folks on this call are JWB clients, but you can expect returns somewhere around 9.5 to 10.5%. Purchase price is somewhere around, call it 225, 250 on average is very normal for us. That's right where this asset here is on Oakhurst. And about 90% of our inventory currently or more is new construction. And we love new construction. We love renovated homes, but it's always nice to look at the pretty pictures of a new construction home. So that's what we have here for this house on Oakhurst. And again, almost without exception, your homes are rented with long-term leases by the time you put them under contract. If it's not under contract with a rented lease, with a long-term lease in place, it will be there by the time you close on it. So you're getting fully occupied and long-term lease properties that are maximizing your cash flow in the short run and in the long run.
Yeah, and that's not a typo on price. I feel like a lot of folks that invest with JWB are coming from like the West Coast, the Northeast, these like bigger markets where they're like, whoa, so what now? A $236,000 home, 3 bedroom, 2 bathroom, standalone, new construction. That's real, right? Like that's the power of this market that is still really underpriced and still has really, really like plenty of space for upside in this like booming economy that's happening. So you are really seeing that is the cost of a home in Jacksonville really is that, and it makes your dollar go further when you're coming from these higher price markets like I did when I came from Miami. GC, tell me some more about this. This is
Yeah,
the
so
investment portfolio. Yeah.
minimum investment, think at the very least, you'll need to put down either 20 or 25% for your assets. So that means about $50,000 to $75,000 at the very minimum per investment property is what the market is bearing today. So again, returns around 9.5 to 10.5%. For interest rates, interest rates are down from where they were a month ago. They're down from where they were a year ago. And so recent clients are actually closing at about 5.25%. And we do have multiple incentive packages. So I think that's probably where we'll wrap up the call today, but super timely, guys. We are running the biggest incentive packages that we have ever offered. We're combining kind of all of our incentive package ideas that we have used over the last year or so as interest rates have been higher than we wanted. And so right now, for clients that for clients that put properties under contract, they'll get somewhere around $13,000 in incentives. And the reason we're doing this is because we like to make clients happy and we like to start off the year well ahead of our sales goals. So it's a great way to start off the next year. That $13,000 is broken up into these incentives that you see. JWB is paying 2% of your closing costs, which comes out to between $4,000 to $6,000 per property. We're also paying 2% of the purchase price as a maintenance credit. And this is a wonderful way to walk into a property knowing that you have the first $4,000 to $6,000 of maintenance costs that will be coming your way sometime already paid for. And in addition to that, JWB is waiving the first tenant placement fee. This is available only for the first 25 properties in the month of December. So we have been running this for quite a while now in the month of December, 19 days. We are pretty close to maximizing the number of properties that can be using this. I think it's somewhere around 5 to 10 properties are still available to be able to use these incentives. And once the end of December comes, that will be the end of it and those incentives will go away. So super encourage you to reach out to the team if you haven't yet. This is a great time to give yourself a Christmas present, a Hanukkah present, whatever you are celebrating. Give yourself the gift of profitability from rental property investing and do it with these incentives in mind.
I love it. I just shared the phone number 904-293-0341 in the chat. 904-293-0341. Last couple things here. GC, what's this over here?
You know, I always just love sharing this. This is such a community win together, us in the community with our clients, right? When I say the community, I'm talking about our Not Your Average Investor Show community. We are making some real moves. We are making an impact. JWB clients have earned over $305 million in profits from their JWB turnkey rental properties. And we actually kind of have a little bit of a leaderboard here. We have three clients that have earned over $2 million in their portfolios by doing just what we're talking about here, using a 1031 exchange, leaning on JWB's network, putting these investment plans together. $2 million. Pablo, three folks out there. We're really close to number 4, but three folks have earned $2 million. How cool is that?
I think it's amazing. Well, is this out of all JWB clients, or is this just the folks that come to the Not Your Average Investor show?
This is all JWB clients. We've
Okay,
tracked
cool.
this since 2011.
This is cool. Yeah, yeah. This is awesome. I love it. Coming close to 4, $38 million plus, 162, half a mil plus, 767, 100K plus. I'm one of those 767. Hopefully get into that 500K plus soon here. But I love that you started keeping track of this and keeping this scoreboard. And we got to figure out some kind of awards to give out for these milestones. We've been thinking about it. Kind of like a YouTube golden button or something like that. So just to reiterate, text us at 904-293-0341 to get this presentation, to ask a question, to get started. And we'd love to. We're going to answer some questions now, Claudia, if you have a little bit of time. But like, we would love to invite you. Next Tuesday is the 24th, so we won't be having a live show, but we're right back into the rhythm on the 31st, answering some frequently asked questions on the Not Your Average Investor show. It feels a lot like this. It feels like kind of a good time. Two people that like to make fun of each other every once in a while, but give a lot of value and a lot of education, and always people in the chat that you can make a friend, ask a question on your own. And it's a really vibrant community where we have events and stuff like that. And people have made best friends. So come make a best friend with us. Go to nyais.com. I want to start off with Sergio Prieto, Go Gators. His question is particularly intriguing to me because, as we all know, we're going through this like generational wealth transfer of like boomers handing down their portfolios of properties to their children. And he's saying, my brother and I are heirs to our parents' house. My question is, if multiple owners are involved in a property, can each owner, my brother and I, perform our own 1031 exchange on our respective share of the proceeds?
Great question. It really depends on how you own the property that's being sold. So if you and your brother own the properties where you're both on the deed, or what we refer to as tenants in common, right? You have 50%, your brother has 50%. You can each do your separate exchange. It's just that when we're doing our exchange documents, we're describing your sale property as 50% undivided interest in 123 Main Street. This leads to another situation that comes up pretty often where, let's say you own the property being sold in an LLC, like Jacksonville Investments LLC, and you and your brother are members. Now, in that scenario, you can't do an exchange with your interest in an entity. Even though it feels the same that you own the property with your brother in this LLC, the IRS, there's this clear distinction between a membership interest in an LLC to owning it together as tenants in common or both on the deed. But yeah, absolutely, you can do it. And even if you do have it in an LLC with multi-members, just give us a call. We could, or JWB a call, and then we can get you, then we'll talk to you. There is a way, there's some solutions to that. But yeah, absolutely. If you're both on the deed, you can do your separate exchanges.
All right. Robert Shapler here, who's a new name to us. Welcome, Robert, is asking a couple of like sophisticated questions here. He clearly knows his stuff. He's asking, can Mark now depreciate the new properties?
Yeah. Yes, he can depreciate the new properties. However, one of the things with a 1031 exchange, remember how I was saying how the tax basis moves over into the new property? So for example, we sell a property for $200,000 and it has $100,000 tax basis, right? $100,000 gain. If we buy a property for $200,000 in an exchange, well, then the basis is $100,000. It will continue with that same depreciation schedule on that $100,000. We don't get a brand new depreciation schedule or a cost basis of $200,000 in exchange. It's what you purchased the property for minus the gain you deferred. However, if you buy up in value, right? You like Mark did, where you're acquiring multiple properties and they add up to a higher value than what you sold for, you do get to add some of that value to your depreciation. So hopefully that was clear. But if you're just buying across same value, same depreciation schedule, if you're buying up, you're increasing the amount you can depreciate.
There's the value right there of working with the best of the best, because that one was hard for me to follow, and I know a thing or two about this. That's why you got to have a great team. And Claudia,
I was
why don't you share your contact information for everybody as well?
Oh,
Um,
absolutely. Yeah. So again, I'm a licensed New York, Florida attorney, worked for IPX 1031 for the last 17 years. But my number is the 800 number to our office, to the Southeast Regional Office, but we handle exchanges all throughout the country, 877-494-1031. And then my email is claudia.kiernan, Kiernan, at ipx1031.com. So it's I as investment, P as in property, X as in X-ray, 1031.com.
great prompt there, GC. I was just sitting here blown away by the expertise. I'm like, that's what you have an expert on. I love it. All right, a couple more questions here. Mike Foster is asking the question: do you think it would likely ever realistically make sense to 1031 a JWB property in order to purchase another one or two JWB properties? In other words, going from JWB to another JWB. Do you think that would ever make sense, GC?
I mean, you got to ask yourself, why are we talking about doing a 1031 exchange? Typically, it comes down to a better market and asset, and it's a better profitability of that market or asset, or just better overall experience. So my simple answer there is probably not, because you're going from the same asset and the same market of a JWB property to the same asset and the same market of a JWB property, and also the same experience. So realistically, not really a scenario where it makes sense to 1031 from a JWB asset to another one. It's and you might, so another common thing is somebody says, well, you know what? I had more cash. I had a maintenance item on this property or something along those lines. Does that mean that I should go and find another property? And the answer is no, because guess what? Cash flow surprises happen to everybody when you're a rental property investor over time, right? That's the value of buying and holding. And just because there may have been one cash flow instance, right, a maintenance item that happened that you didn't expect, there is no reason that that should continue there, or there's no reason that we know that that's not going to happen at some point on the new property. So following the model, following the team, the model, staying in Jacksonville just to go to another JWB property, probably not going to be a good idea.
Okay. Ronald Thwing is asking, every few years, can you transfer your basis from one property into another property to keep rolling a higher basis into the next property?
I think it's kind of the same question as before. You have to be careful. I'm not sure. I might need more information. Are you saying that you're selling a property and buying another property from yourself, and that other property has a higher basis? If that's the case, then we have to be careful, because what the IRS doesn't like is related party exchanges, where we're selling and buying a property from another entity or family member that we're related to. Then we fall into these rules where that related party seller also has to do an exchange. So we don't want to be doing what we call, which kind of sounds like your question, but I'm not 100% sure, is what we refer to as basis shifting, where we're selling a property with a low basis, ending up with a property with a higher basis, so that when we sell it, we're paying less in tax. So I think that's where you were going with that. I'm happy to talk to you offline, but yeah, you'd have to be careful with that one, right? Because the whole idea with the exchange is that you're in the same position you were in as before. You're reinvesting into new property. If you didn't keep exchanging and leave the asset to your heirs and have the taxes permanently go away, when you eventually sell, the idea is why we're able to do this is that you would be paying the tax at that time. So we'd have to be careful with basis shifting.
Good stuff. Good stuff. And he said, yes, you were answering the right question there. So last question here that we're going to answer from our friend Reggie Fonse before we bid adieu says, my property in Maine is in an LLC. I am the only member. When I buy a property or two with JWB, can we put those properties under an LLC owned by both me and my wife?
Ooh, another good question. No, we wouldn't be able to do that, because you could buy a replacement property in another single member LLC that you're the sole member of. But if we acquire a property with a spouse, that is actually a multi-member LLC, considered a partnership, and it would be a different taxpayer. One thing I've been amiss on is that I didn't go over one of the basic rules of another basic rule of 1031 is that the taxpayer that's sold has to be the taxpayer that acquires in a 1031 exchange. So in Maine, If your single member LLC is what we call the disregarded entity, it's not checking the box to be taxed as a corporation, then the sole member, meaning you individually, is the taxpayer. So when you go to buy a JWD property, you have a couple options. You can either buy in your individual name, in a brand new LLC, but you have to be the sole member. So you wouldn't be able to go from that single member LLC to a multi-member LLC, even if it's with your spouse, with one exception, is that if you lived in a community property state, which are 9 states, which Maine is not. I'm just assuming that you're here on the East Coast, but if you do happen to live in California and you're in a community property state, there is an exception to that where multi-member LLCs can be treated as ignored or disregarded entities.
All
Again,
right.
happy to talk offline if we need to go into more details.
Sounds good. Sounds good. All right. We have reached our time limit for today. Great questions, great attendees. Never take it for granted that folks take an hour of the middle of a workday to come, learn about real estate, ask us these questions. Claudia, I got to say, you absolutely killed it. Like, I thought your level of clarity, your conciseness, how simple you kept it, it made even a real estate fool like myself really come to like a new, clearer level of understanding on this stuff. So really, really appreciate you coming.
My pleasure. It was great to be here with the family, the whole group, and happy to join you guys again.
Cool. GC, before we sign off here, Gary Griggs has a good question here. He says he's going to be traveling through Jacksonville on his way to his brother's house for Christmas. What are JWB's working hours during the holiday period, and is the office accessible for him to say hello? I was going to initially just like chat him and say, hey, if you're a client, reach out to your portfolio manager, and they can set up a meeting with you when you're on the way down.
100%.
Any other way? Yeah.
That would be great. If he's not a client yet, just send an email to info@JWB Companies, and we'd love to get some face-to-face time with you.
Yeah, we'd love to see you, Gary. On your drive down. GC, give us some
just
kind of like wrap up thoughts here.
I think the office is closed on Christmas Eve and Christmas Day. I know we're closed Christmas Day.
That was the real question.
Yeah.
What other hours?
I should probably know if we're closed on Christmas Eve, but we could probably check Google to figure that one out. Give us an email. We'll figure it out for you.
Cool. Sounds good, man. All right. This was great. Really enjoyed it. Another special edition. This is officially our last time on the air before Christmas. So wishing everybody happy holidays. Well, we will be back before the end of the year, though. We will be back on the 31st itself. On New Year's Eve, we'll have a last show of the year, asking some frequently asked questions as people are going into 2025, wanting to plan their years and set some real good resolutions that you can actually do. That isn't just a gym pass. But from now till then, GC, any little bits of advice for our friends in the Not Your Average Investor community?
First of all, Claudia, we love you. Thank you so much. It's so awesome to think about a relationship going on close to 20 years now. And don't be average. See you, everybody.
Don't be average. Thanks, Claudia.
Bye, guys.